All right, folks, we're going over grading again, section 2. You're probably like, grading? What? There's more to grading? Not really. Okay, I just didn't know how to or where to put this at because it's a totally different technique. It's still using the concept of grading because you're still grading a swing, right? Just getting one high, taking it to the low, applying your quadrants and equilibrium to the range, and boom, there's your grading, right? But with this, it's more of anticipating when price is going to run, when price is going to consolidate, and when price is going to offer an accumulation of positions or basically offer you an opportunity to take your positions to then target. Okay. So let's say, for example, this swing here from this low to that high. Simple dealing range, right? We come down into some equal lows here, got low, low, low. So we already got that there. And then we have the buy side purge there. We got buy side purge and sell side purge, which then creates a new dealing range, which is this one right here. So since you understand that a dealing range is now formed, what we have to do, well, I already applied the quadrants and the equilibrium to it already, right? Within this, you would say, okay, if you're just normally applying grading, you would say, okay, what is price done within this range? Is there any arrays in it at certain quadrants or certain points of this range? How is price going to react to it? What does it react to already? You're basically just dissecting, grading, and looking at the precision in the intricate movements that happened within that swing. Normally, right? But I might just name this anticipating with grading or anticipating delivery with grading. But all you're doing, right, is you are grading. Listen to me. Listen to me very, very carefully. From wherever you are targeting, right? And for example, you're targeting here, okay? Since you're targeting here, you would get your target, right? And drag it or get the range from your target all the way to the deepest point of price where it reverses and then from that point on goes to your target. Get what I'm saying? So you have the actual swing here, okay? Then we have price dropping, dropping, digging deeper, digging deeper, digging deeper, and then we have this deepest low here, okay? Or the deepest point of price action before price started actually rallying and going to your target. Get it? Super simple. So it's just your actual liquidity point to the deepest point of price before it starts rallying to your target. That's it. Need to replay it? Go ahead, skip 10 seconds back, and I'll explain it all over again, of course. But it is that simple. So once you have that range, you should then apply the quadrants and the equilibrium. Okay, don't even mind these bottom lines here because that's just actually, applying the range that you're looking in, right? Now, since we're targeting this high up here or this buy side liquidity or drawn liquidity, whatever you want to say, right? We're taking longs. Now, around the first quadrant, and when I say first quadrant, I mean the first quadrant that gets hit as price is rallying to your target, and obviously this one would be the second one because you have this one coming first and then that one coming second. It's common sense, right? So around the first quadrant, right? Or when I say around it, I mean not below it, okay? But it can be around it. You get the point. It's common sense because I can't believe I have to say these things because some people ask these questions, but it's okay. Questions need to be answered. So around the first quadrant, okay? You would see price offer an accumulation of positions. Okay. What do I mean by offer? The algorithm will literally say, you better hurry up and get your positions in because I'm about to start running. You better get ready because I'm about to start going. I'm really about to start delivering. So around that first quadrant, typically, normally, you would see price prepare, or in other words, offer an opportunity for you to accumulate your positions or get your trades in. Okay, in which you could take this order block here. You could take that breaker. You could take that inversion fair value gap. Well, no, is that a Reaper? No, that's not a Reaper. Oh, man. I love Reaper fair value gaps, but no, that is not a Reaper fair value gap. So you can take that reclaimed fair value gap. You can take this inversion. There's a lot of things you can take here, okay? But let's just say you get your long in right at this reclaimed fair value gap right here. See that? Right there. Let's say you get it in right there. There's your long right there. Boom. You see it respecting it, starting to move away, and you get your long right around here. Let's say right around there. We're gonna have the stop at the low of it could either be that low there, or if you want to be even safer, you can put it at the low of the reclaimed order block, which is a giant stop, obviously, because we're trading on the 1 minute. But I trade on the 15 second, and sometimes 1 minute, so obviously my stops aren't that huge. And even if they are that huge, I do size down. So you got your entry in, right? Now we have to simply anticipate or Just look at the swing that we've graded and see when price is going to consolidate, when is it going to expand, and stuff like that, right? That's the result of me talking so much for 5 minutes straight. Anyway, I might cut that out, might not. But around the equilibrium, there's two things that can happen. When price touches that equilibrium, it can either respect it and offer, and it can either respect it and retrace to come back down to offer more opportunities to get more trades in, or if it does just temporarily respect it, it's likely that price is going to run through it. Okay. Once it runs through it, it is pretty likely that it'll leave behind imbalances that will not get touched. Okay. And even if they do get touched, it will and it should leave behind an institutional order flow entry drill. Okay. Because if you leave a imbalance or a fair value gap, specifically a fair value gap, if you leave a fair value gap around the equilibrium of a range, what is that forming? It's forming a measuring gap. Now, if a measuring gap gets touched, what happens to the measuring gap? It should, normally, if price wants to keep going from that point, it should form an institutional order flow entry drill, right? Now, let me go ahead and hide this real quick. Let me just, how can I hide that? Let me just hide it real quick, okay? Now, looking at the equilibrium, okay, this is the equilibrium. Let's move over, move over. What gap is closest to the equilibrium? That gap right there. That's the gap that's closest to equilibrium. So, like I said, around equilibrium, it'll leave some form of an imbalance. Well, not some form, but specifically a fair value gap. So we're gonna get the not the quadrants, but the equilibrium, and see if we formed an institutional order flow entry drill. And I don't even know, is that an institutional? Wow, wow, that is that's crazy. That's actually super impressive. Okay, just so you know, I'm not lying. I have it directly on each point. See the wicks? Boom, bam. Now I'm gonna keep zooming in, and you tell me if it goes below the equilibrium. Holy Jesus, no, it doesn't. It respects it by that. That is insane. That is obnoxious. What the heck? Wow. But you see that? That is amazing. That's the precision I'm talking about, okay? Now, this is just a technique to anticipate price delivery or intraday price delivery with grading, okay? But that was something that just totally shocked me, okay? So, around the equilibrium, when you do start to see it run through it, okay, in which that normally should happen, if you see it temporarily respect it, it's just temporarily respecting it and coming back down for more accumulation of positions so price can keep running higher and basically have the fuel to keep running higher, okay? Once it's ready to run higher and starts blowing past equilibrium, a imbalanced will be left. If an imbalanced is not left, you could see price starting to slow down, okay? That's what you could see. You could just see it have some super, super low probability price action all throughout your target. It's probably just gonna just do some BS like this. Just go, hold on, wait, let me get my tool real quick, my little tooly tool. Just something like this. It might just do this and just keep going and just keep going and just doing some BS like that until it reaches your target. But since we had that imbalance form, okay, in which we did have a little bit of a retracement around the second quadrant, or a little bit of a hesitation around the second quadrant, it came back down, okay, to quote unquote fill. Well, not even quote unquote, but literally fill the imbalances, okay, in which the imbalance that formed around the equilibrium, which is another form of a measuring gap, but just using grading. If it touches this gap, it should not go below the equilibrium because it's a measuring gap. It's just it shouldn't do that. Okay. It touches it, and I already zoomed in and showed you that it did not go below equilibrium. So this is a what? Institutional order flow entry drill. Beautiful, isn't it? Very, very, very beautiful. Okay. Now, if you do see it respect the second quadrant, okay, it's likely that you're just going to see another run, okay, another beautiful displacement run straight to your target, in which we hit the second quadrant here. Boing, 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 boing. And we just start hesitating around that level. And then we come down, retrace, hit the fair value gap. You get the point. Then we reference this. Well, no, not this would be a propulsion block. So I really don't know what this candle would be. Yeah, this candle would just be an independent candle. So we have no order block, no propulsion block here. We really just only have this fair value gap. So we came down, filled the imbalances. Well, really this one and the upper half of this one here, respecting the equilibrium, causing an institutional order flow entry drill, showing that we want to continue going higher, in which the next run, okay, according to what we have been anticipating with the grading technique, we should anticipate a beautiful displacement through the second quadrant. Does it do that? Yep, from that point on, displaces straight through it all the way to your target. Simple, right? Very, very simple. Now, just to explain this verbally, so you won't get a little confused or can have any confusion at all, in a bullish example, which is right now, right? We're going to just drag another fib right here and apply the quadrants, just like so, right? If you're buying or you're willing to take longs going up like this, if you want to see just going up like that, if you're willing to take longs, around the first quadrant, you would see an accumulation of positions or the algorithm offering you an opportunity to take your trade, okay? Or in short, you would see an accumulation or preparation around that first quadrant. Around the equilibrium, okay, if price is truly ready, I said ready, if price is truly ready and has done everything that it needs to do at that first quadrant, it'll normally displace through that equilibrium. Okay, simple as that. And the imbalance that forms closest to the equilibrium, I chopped that word all the way up. I said equilibrium, but around the equilibrium, the closest fair value gap that forms to it, or the closest fair value gap around the equilibrium, can be used as a measuring gap. Okay, and for example, if price does decide to run through the equilibrium, of course, and then hit that second quadrant and temporarily respect it, what it'll normally do is come back down, go to that fair value gap, which is that same fair value gap over here, which was beautiful. It'll go back to that same measuring gap, fill it a little bit, all the way until just its equilibrium. Why is that? Because if it wants to go higher, it's going to create algorithmic signatures that say it wants to go higher, in which that was a very, very algorithmic signature. That's not random. That just shocked me because reminder, all my videos are unscripted, so I didn't even know that was there. So it's going to come back down to the equilibrium or around it and look for that fair value gap that's closest to the equilibrium in the form of a measuring gap. Come down to it, respect it, create an institutional order flow entry drill showing that price wants to keep going higher. Then it's going to go right back higher, and then you're going to see the second quadrant get completely blown through, right? But in a typical situation, that's just using if, ands, and buts, like if price temporarily respects the second quadrant, if price temporarily respects the equilibrium and stuff like that. And that's one thing I did forget to mention. If it does temporarily respect the equilibrium and it doesn't want to run through it yet, you would likely see it come back down to visit the um the first quadrant to accumulate positions a little bit more or to prepare a little bit more before price actually starts expanding, okay? In which that can also be paired with time. You get the you understand. Stuff like that when it's dealing with preparations and accumulations, that's very, very much paired with time, in which I just said that like 3 times, so I'm sure you understand what I'm talking about. But you can pair time with those, um, I wanna say the word anticipations, but I feel like I'm gonna chop it up in which I think I just said it right, but for some reason it sounds so wrong. But with those anticipations using the first quadrant, equilibrium, and second quadrant, or whatever you want to call these, okay? Because this is just a bullish example. You will use the anticipations of this to properly work your way through price so you can really understand what it wants to do. And like I said, I was going to explain the typical, normal, high probability price action part, okay? Let's say we're using a bullish example again. You went along around the first quadrant, typically, super typically, let's say price is clean, high probability, no sort of low probability price action anywhere, right? You would normally see the first quadrant get accumulated around to offer positions, of course. The equilibrium will get ran through beautifully with displacement, and then the second quadrant will continue that delivery and get ran through beautifully all the way up to your target. Okay, that's just a super typical situation that that should normally happen if you have that high probability, smooth, aggressive type of movement when price action. Of course, that's just the normal. That's the norm you would want to expect. But if you have some conditions like this where it's kind of stubborn, then of course you have to use the if and buts and basically look at the respect of the second quadrant, see how it's treating the equilibrium, and basically looking at what price is doing and see what it could do after. And it's simple as that. It's nothing too hard. Now I'm gonna go over a bearish example because I don't want to just give you um, one side of this. I got to work both sides of your brain. So let's go over here to Monday, which I think Monday was kind of awful too. Yeah, this is kind of bad. Let me go ahead and turn on my kill zones. Hold on. And then where is Monday? That's Monday right there. Okay, nice. Oh yeah, that was pretty bad. I'm not even gonna go over that day. That was horrible. I need to find you a bearish example. Hold on. Hold on. I'm trying my best. I'm trying my best. Okay. So let's see. There's a lot of lows down here. Let's say you targeted those, right? Okay. Yeah, there you go. Let's say you targeted those. So from the actual, remember this, okay? From the actual target that you have, or drawn liquidity, or point of liquidity that you're looking for to target. Remember, oh, what the world? What is that in my throat? I've been talking for so long, my voice sounds corrupted. But whatever point of liquidity you're targeting, you want to get that point or the deepest point of that liquidity, if it's multiple points like this, to, okay, whatever swing that forms in, to the deepest point of that swing in which it reverses to then begin running towards your target. Okay. So I'm gonna say this one more time. From your target to the deepest point of that swing where the target forms in which after that deepest point, it should begin, reversing into your target. In which I still feel like I'm explaining that wrong. I'm going to explain it one more time. From your liquidity point, you want to get the fib from the liquidity point to the deepest point of that swing before it reverses into your target. Okay, I think I explained that well. I just had to make sure you understood that, because I be thinking in my head like, am I explaining that right? So I just got to make sure I'm giving it to you well. All right, so let's looky here. We're on 15 minute. So if you want to see the kill zones, there they are. Actually, no, that just completely blinds everything. Never mind. Okay, so let's say you're targeting here. This is New York session right here. This is New York right here. That's New York session all right there. As you can clearly see, it's increased volatility, and you can just see the displacement from the New York delivery. All right. So around the first quadrant, since this is a bearish example, it's an example from the first quadrant. What is supposed to happen? An accumulation of positions. Okay, when price actually begins reversing from that deepest point of the swing where your target is in, that's the deepest point right there. When the price starts reversing to go to your target, what's the first quadrant? This one right here. That's the first quadrant. So once prices are round, or basically goes a little past, or basically is just in the distance of the first quadrant, you would normally see price begin to consolidate, or basically reference a lot of PD arrays, signatures, and do a lot of things to offer you positions to get into price so you won't miss the move. I'm having so much brain fog right now, but basically, you get the point. Around the first quadrant, you're going to see a lot of accumulation. Well, not a lot of it, but you're going to see some consolidation, and basically a whole lot of references and signatures being created to offer you opportunities to actually get into the move that's about to deliver. Now, for the equilibrium, okay, typically, normally, okay, if you have that beautiful price action that we expect, or that you're normally supposed to have and not have. Of course, who wants low probability price action? Who wants that? I sure don't want that. You sure don't want that. We just want a nice, easy day. So we're always assuming the best, okay? Let's say we have that best price action. Typically, you would see the equilibrium get ran straight through. And if we look over, it runs straight through it. Simple, right? And like I said, if it temporarily respects, and as you can see, it temporarily respects it right there, goes down below it, comes right back up, hits the order block right there, hits the inversion fair value gap, hits this breaker, hits this fair value gap. It does a whole lot within that area, okay? So like I said, if it respects the equilibrium temporarily, what you would want to see is price bounce back up around the first quadrant, okay, to offer you more what? More opportunities to take a potential trade, okay? That's up to you if you want to take it. It's giving you the opportunity. It's like, here, you want to take this trade? I'm giving it to you. You want it? That's exactly what it's doing. In which it did it multiple times. It hit that breaker, hit that order block, hit that inversion, hit this fair value gap with the. Is that an institutional order flow entry trail? Let me see. Let me see. I'm like literally zooming in on my monitor like I'm some old dude. Oh wow, yeah, that's an institutional order flow entry drill. Yep, that is an entry drill right there. See that? Beautiful. So as you can see, in temporarily respected equilibrium, came back up, offered more opportunities for you to take your trade. Then, since it did that and it actually respected those arrays, okay, it can do that, but is it going to respect those references that it referenced, to say the least? Yeah, it did that. So since it's respecting it and offering that movement away from that, we can now see the equilibrium get ran through, in which we do see the equilibrium get ran through, in which typically, normally, since we're at the second quadrant, you would normally see that move continued and you would see a quick run to your target. In which do we see that? Yep. Look at the second quadrant. Around here, got a little bit of respect here, but of course, you're still going to see price have that quick run. All right. Now, if you want to drop to a 5 minute and see how it looks, sure. I'll drop down to a 5 minute so you can see it. All right. There we go. That's a little better, isn't it? Yeah, a little better. So it's a bit more detail. As you can see, first quadrant gives you the opportunity or accumulates positions for the smart money traders. Equilibrium gets temporarily respected, referenced back up into that fair value gap. This inversion fair value gap within that 15-minute breaker that's around here. And then after it temporarily respects it or comes in for that short-term retracement, we start to deliver lower past equilibrium, which should normally happen after that. After you get that temporary respect, which normally doesn't happen, but if it does happen, you're supposed to see immediate or as soon as possible get some sort of respect in movement after it's offered that temporary opportunity or that short-term opportunity for smart money to not miss their move. Okay, because that's all that was. That's like basically it's your at least your last chance. You better come on. I'm about to start delivering. So this your last chance, Bucko. In which it also happened during a macro, in which macros can do two things: seek liquidity, or do what? Rebalance imbalances. In which it did exactly that. We rebalance this one, and then we partially rebalance that one there, and then we rebalance equilibrium or rebalance half of that 15-minute one also. So it was within the macro. It gave you that opportunity. If you didn't want to take it, bye bye. We run through the equilibrium and we keep going, keep going, keep going. We run through the lower quadrant. I mean, not lower quadrant, but we run through the second quadrant, which is supposed to happen. And then boom, we hit your target right down there. Okay. This is the end of section two of grading. Okay. Well, we really didn't go over grading. We went over, um, we used the technique to find the ranges using grading, but we did not actually grade. We just simply were looking at the range that we get from grading and anticipating price delivery or intraday price delivery with grading. Okay. But it's still grading. So I just said the word grading like 7 times in a single sentence, but you get the point. I'm sure this helped you a lot when it comes to anticipating intraday price action. Okay. Um, if you see price go outside those typicals or those normal scenarios I just gave you, it's likely that you're in some low probability price action. Okay, that's one thing I will say before I end this video. But anyway, enough of me talking. I've been talking for 25 minutes now. I'll be in this video here, and I'll see you in the next one. Good luck and good trading.